Hi folks, welcome to this video on fair value through OCI investments. Now we're going to do a little problem here that looks at adjusting fair value for through OCI investments to their fair value where there are transaction costs. And you remember that when we have fair value through OCI investments, the rule is that if there's any transaction or brokerage costs in the purchase or the sale of these investments, they are capitalized or included as part of the cost in the investment account. So in this particular portfolio of investments held by a corporation, they have three different companies in which they have shares in. They have shares in Nirmala, Oksana, and WTA. We know that in Nirmala they have 9,000 shares that they bought at $33.50 a share. Oksana, 5,000 shares at which the corporation bought them at $52 a share, and 7,000 shares of WTA at which the corporation paid $26.50 a share. However, because they paid brokerage fees of $1,980 for Nirmala, and $3,370 for Oksana, and $2,910 for WTA, we now have extended costs for each of these investments as I'm highlighting here. So now when we go and record the purchase of each of these different shares, Nirmala, Oksana, and WTA, at the different dates itemized in the question, we're going to debit the fair value through OCI investments, which again, as we said before, are long-term investments, and we're going to debit them for $303,480 and credit cash for the same amount. For the investments in Oksana that we bought April the 1st, we will again debit that control account fair value through OCI investments for $263,370, which again includes the capitalized cost, meaning the transaction or brokerage fees, and credits cash for the same amount. And again on September the 10th, that's when we bought the WTA shares, we will debit the fair value through OCI investments for the amount that we paid, which is $188,410, and credit cash for that amount. Now we get to May the 20th. Now on May the 20th, we decided that we would sell part of the Nirmala shares. We are going to sell 3,000 of the 9,000 Nirmala shares that we bought earlier in the year, January 15th. So now on May the 20th, because we are selling some of the Nirmala shares, we have to do 3 steps because it's a fair value through OCI investment. The first step is to update the investment account for the shares, the 3,000 Nirmala shares that we sold to their market or their fair value at the date of sale. So in order for us to do that, we have to determine what is the fair value and what are we carrying those shares at. Now we only want to know the value of 3,000 shares because we're only making this entry for the 3,000 shares that we're selling. So now we sold them at $35 a share, but don't forget the amount at which we're going to get from the shares is net of the transaction fees that we paid, and we paid brokerage or transaction fees of $28.50. So if we take the 3,000 shares that we're selling at their fair value at the date of sale, which is $105,000, we have to deduct from that the brokerage or the commission. We're only going to pocket $102,150. We compare what we're going to pocket or get from the carrying value of those 300 shares. Well, we were carrying all 9,000 Nirmala shares at $303,480. We are now going to be losing 3,000 of those 9,000, or 1/3 of them. So we want to now remove 1/3 or 3,000 of the 9,000 of that carrying cost, which is $101,160. So now we're going to have a gain on those shares of $990. So therefore, we would debit the fair value through OCI investments and credit an unrealized or holding gain or loss that would move through OCI of $990. The next thing we're going to do, the second step, is now that we've updated the investment to $102,150, now what we're going to do is sell that investment and realize that cash of $102,150 and clear off the fair value through OCI investment that we've now, when we made this $990 adjustment, don't forget, we upped it. It was sitting in our books, those 3,000 shares at 101,160. By adjusting it upwards as we did here with this debit, it now sits at 102,150. So now we're going to clear it out because it's sold, and we're going to realize the cash from that sale. So now, the third step we need to do when we're dealing with fair value through OCI investments is that we now have to recycle the cumulative unrealized gain. In this case, it's a gain. It could be a loss, but it's a cumulative unrealized gain. Because the question said we are recycling, or it's with recycling, that means that that cumulative unrealized gain or loss, but in this case it's a gain, on those Nirmala shares has to be recycled through net income. Remember that under the current rules, we can either recycle through net income, all right, or with recycling means recycle through net income, or it's without recycling, which means it goes to retained earnings. This question specifically said that it is recycling, or with recycling, which means it goes through net income. So therefore, how much are we going to recycle? Well, this question made it a little bit easy for you because they told you that 2014 is the first year in which the company had invested in equity securities. So we know that there were no previous unrealized gains or losses in past periods on any of these investments. So the cumulative unrealized gain or loss is only the unrealized gain that we had this year, and that was for $990. So therefore, what we're going to do is we're going to remove this unrealized gain or loss through OCI, and in fact a gain because we've credited it for $990. We're going to debit that account and recycle it through to net income, which credits the gain. So we remove it from our unrealized gain or loss in OCI, and then we credit this gain. So now, at the year end, so that concludes this section of it. So those are the three entries that you need to do in this question in order to adjust, first and foremost, our Nirmala shares to its net proceeds value, which is 102,150, sell the investment, and then recycle this 990, or the cumulative unrealized holding gain or loss, which we've only got it for 1 year because we've only been holding this investment for 1 year. So in previous years we had no cumulative, nothing from previous years, nothing in 2013, 12, 11, whatever, because this is the first year we've held the shares. So what we have to adjust in our cumulative amount is only the 990 we booked this year. So now we have to recycle the cumulative unrealized gain or loss, in this case gain, through to net income. So we credit the gain account and debit the unrealized gain or loss. So in other words, we're removing it from the unrealized gain or loss. So we're taking it out of here. So we have to debit it, and then we're crediting it to put it through net income. All right. So that concludes this piece. Now the question said, what are we going to do at the year end to adjust the portfolio once we've gone all through this stuff, right? What are we going to do at the year end, December 31st, to adjust the portfolio to its fair value? Well, now what have we got in the portfolio? Now you got to think. We've only got 6,000 shares in Nirmala. We didn't do anything with the 5,000 Oksana and the 7,000 WTA shares. So the carrying amount there doesn't change. These carrying amounts here for the Oksana and the WTA are exactly what we had up here, right? There's the Oksana, there's the WTA. We just have a problem here with the Nirmala because now we're only carrying 6,000 Nirmala. So now we're carrying them on our books at 202,320. That would be their carrying amount. Or 303,480, which was the value for 9,000 of them, but I only want it for 6,000 of the 9,000, or 2/3 of them. So that'll give me 202,320. The other way you can look at it is you could say, well, I originally had the investment in the Nirmala shares at 303,480, which was up here, right? We had it up here. And then what did I do to that investment during the year? Well, I adjusted it. I increased it by $990 on May the 20th when I adjusted it to its fair value. Okay. And then what did I do to it? I removed 102,150 in step 2, right? This step. I credited the investment for 102,150 because that represented the amount of cash I got for it. So this had to do with the Normalis shares, right? So what you could do is you could also just say, well, just follow through with it, just manually. Say, started at 303,480. I increased it by 990 when I did step 1, right here. And now I also reduced the fair value through OCI investment when I sold the Normalis shares, right? So I can just follow it through that way and get 202,320. My preference is just to do it directly and say, well, I've only got 6,000 of the 9,000 shares. The 9,000 shares I valued at 303,480 when I bought them. So that's 202,320. So now what am I doing? I got a carrying value for the shares at the end of 2014 of 654,100, and then I've got 651,000. Okay, so now I know my unrealized gain or loss for the total portfolio. 654,1 less 651 is going to give me 3,100. So that portfolio is going from a carrying value or carrying amount which is higher than the current fair value, so it's going down. So now the entry I'd make is to debit the unrealized gain or loss, and because I'm debiting it, it's a loss, which will run through OCI, 3,100, and I will credit my fair value through OCI investments to bring it from 654,1 to 651, and that will be a credit of 3,100. Okay? Now the question asks you, how would your answer change if they adopted IFRS 9 in 2014? Well, if they did that, all that means is that in 2014, they would not have recycled through net income. They would have just recycled through retained earnings. So instead of making a journal entry up here, which would have debited the unrealized gain or loss and credited the gain on the sale of the investment, we wouldn't have credited the gain. We would have credited retained earnings. So we wouldn't have recycled through net income. So what we would have done here is we would have just credited retained earnings instead. So the change is in step 3. Steps 1 and 2 will not change, no matter if it's with or without recycling. But now that it said, if they adopted the IFRS 9 standard in 2014, what that standard tells you is that it doesn't support recycling through net income. You would have done it directly to retained earnings. So you would credit retained earnings for $990. Okay? So now, this concludes what the question asked you to do in order to prepare the journal entries to process the sale of those shares, the Normalis shares, and to do adjusting entries at the end of 2014, okay, to adjust the securities, the portfolio fair value through OCI securities to their fair value, which is 651. In the next short video that accompanies this question, what I'm going to do is walk you through the statements. So this concludes this section.